Hey guys, it's Sam and welcome back to the YouTube channel, or if you're new here, it's nice to meet you. Now in today's video, I'm going to be guiding you through all the basics as a first-time buyer getting a mortgage here in the UK, explaining what a first-time buyer is, who's eligible, all the way through to picking your term, product, and your interest rate. We'll even talk about what schemes are currently available for first-time buyers. And as a little bit of a pre-warning though, this video may seem a little bit all over the place since it's not in an order as such, but it does contain all those important tips and tricks and information that you'll need to know as a first-time buyer. So if you're interested in learning about first-time buyer mortgages, then I'd highly recommend that you subscribe to our YouTube channel. It's dead simple. You just hit the button below and it's literally labeled subscribe. And the best part, if you do, you're going to get a new video every Monday, though sometimes we might miss an upload or two. And if you're not, and you're not here for mortgages, then you've listened for a minute and a half probably, and you're not in the right place. So see you later. Anyway, I've gone through enough of this intro, so let's get to it. So let's slow down and take a look at what is a first-time buyer. Well, a first-time buyer is someone who has never owned a property before. As a first-time buyer, you'll qualify for, yep, you guessed it, a first-time buyer mortgage. I feel like I'm sat here just saying first-time buyer the whole time. Is that what I've got to do for this whole video? But anyway, let's make it a bit funny. If you want to, take a little shot every time I say first-time buyer and see how funny this gets. Now, first-time buyer mortgages are specially designed for people who are new to the housing market. Lenders may offer incentives or higher loans of values like 95% mortgages or even 100% mortgages, which mean you don't necessarily have to put a deposit down. A loan to value, now this just means the ratio of mortgage or the total loan that you're borrowing to the value of the property. Now you might see it as like LTV or loan to value, both mean the same things. Okay, so to choose the right mortgage for you, you'll need to consider a few things. So we're going to start here with interest rates. Now, the interest rate is what it'll cost you to borrow money. So if the rate is 1%, that means if you borrow £1, over a year, you're going to pay £1 and 1p. If rates are at 44%, and I'm hoping they never get to that stage, then if you borrow £1, you'll need to repay £1.44. Now, whilst that's dead simple, when you borrow a large amount of money over a longer period of time, the interest can really stack up, even if the interest rates are pretty low. So for example, if you borrowed £150,000 with an interest rate fixed at 5% for the whole 25 years, you'd repay £113,000 in interest alone. So next up, we've got the monthly repayments. Now, your monthly repayments are calculated by the mortgage amount and the total interest you'll pay divided by the number of months that you want to borrow your money over. So using the previous example, if you borrow £150,000 with a term of 25 years, you could expect to pay a mortgage payment of around about £877 per month. Then we have the mortgage term. A typical mortgage term is usually about 25 years. However, lenders can offer you a mortgage much longer and depending on your age and personal circumstances, and in some cases you can have a mortgage term up to 40 years, believe it or not. If you choose a longer mortgage term, the lower your monthly repayment will be, as it's obviously going to take you much longer to pay off. However, you'll end up paying a lot more interest to the lender over a longer period of time. And if you choose a shorter mortgage term, the higher that monthly repayment is going to be, but you will clear your mortgage quicker and pay less interest back to the lender because you're paying it off, say, 10 years quicker. Now, when choosing how long you want that mortgage to be, you need to think carefully of your monthly budget because you're going to be committed to paying this every single month without fail. Nothing higher, nothing lower, not missing payments. They need you to pay it every single month. So let's talk about the deposit required. Now these days, it's really common to have a 10% deposit and that'll give you a pretty good choice of mortgages. Though it's been changing with lenders offering more low deposit mortgages, and it's even possible now to purchase a property with 5% deposit or even 0% as your deposit. Yet to get a good mortgage with an interest rate, you'll often need more than 20% of the home's value. And to get a really decent mortgage interest rate, you'll probably need about 40% of the purchase price as your deposit. The bigger the deposit, the better the interest rate. The lower your monthly repayments, the cheaper the mortgage. All seems pretty straightforward. The difference between a 5% and 10% deposit can be huge. The next big jump's at 20%, then 40%. So if you have any chance of pushing yourself up to a band, let's try and have a look at it and see how that might impact your future mortgage payment. Now, there are literally tons of lenders and genuinely thousands of mortgage products for you to choose from. And obviously, I'm going to say use a mortgage advisor because That's what we're here to do, to compare deals on the table and present you the best recommendation for you and your personal circumstances. To apply for a mortgage, you're going to get your things in order, which we're talking about documentation. And there's a few of these things that you need to have ready, such as your latest 3 months pay slips, your national insurance number. I'm awful at remembering mine. Don't think I'll ever be able to do it. You'll need your ID, proof of employment, proof of income, a copy of your credit report is always really key, and details of any current debts. And a couple of other things which we do go into detail in another video, so we'll leave the link in the description box for you to go and check it out. After this one, obviously, make sure you stick around. When it comes to finances, it's always better to clear any debts that you can. Now, I appreciate in saying that, if you have a car loan, the chances are you're not going to be able to go and wallop that entire loan off. But if you do have a few £100 on a credit card or Klarna or PayPal or Monzo Flex, for example, then you might want to think about clearing that before you apply. This will only go in your favor on your credit report. Now, we do have a link to check my file below, which you can pull off a credit report. And finally, let's look at ways you can boost your affordability or your chances of getting a mortgage. Lenders can be picky about who they give mortgages to. For example, getting the best mortgage deal doesn't just need a decent deposit, it'll require you having a good credit score too. And you can boost your score with some simple ways like making sure in the electoral roll, checking your credit file regularly to make sure there's nothing on there that shouldn't be, keeping up to date with your payments and keeping your credit applications down, and making sure your credit card utilization is pretty low as well. Straightforward, isn't it? So there you have it, a quick-ish guide on the basics of first-time buyer mortgages. And remember, you need to be considering the right things for you, such as the mortgage term, affordability, mortgage product, interest rate, and how much deposit that you'd like to put down. Now look, if anything we've said today doesn't make sense, please reach out to one of our friendly team on 01925 573 328. And don't forget, download our free first-time buyer guide, which is also linked in the description box below. See you next time.